We have seen a robust demand increase for close to a decade already. We can see the private investment market is growing and the participation rate from the mass market is increasing. You can see the passage of crowdfunding regulations. There is this demand to relax accreditation rules. And we also see the increasing participation from a large number of family offices and wealth managers into the space.
What was the problem you were trying to solve when you founded WealthBlock.ai?
It's really to break down the barriers to allow mass distribution of alternative assets. So there's clearly a demand on one side that more and more people, institutional and retail, high net worth individual, affluent, mass affluent, all seeking to get more exposure to alternative assets or private investment. But there is this barrier of entry in between to allow them to enter. And it's the same demand from, let's say, the supply side. The private fund managers, big and small, they all want to also supply to that to fill that demand. But because the infrastructure is missing and it's highly frictional, therefore they're not able to do so. So from the supply side, and let's say a private equity fund manager needs to raise capital for, let's say, $100 million fund, and then it's a quite tedious process for them to go out there to court investors, maybe especially if it is a smaller check size, right? The institutions, each one can write you a multi-million-dollar check, $10+ million check. That's relatively speaking, maybe easier in terms of time. But if you go down the chain to say talking to family offices, each one can write you $1 million check, or individuals are writing you, let's say, a $250,000 check. Then you have to deal with a large number of them. So with each one of them, that you need to do initial meet and greet and the presentation and the follow-up to get them interested. And also in between, you are responsible as a fund manager to keep all the compliance requirements in place, and such as what kind of material you can show, what you can say, etc., and what other kind of correspondence you've had. Now, when they are finally decided to invest, now the kind of a real fun starts, right? So you need to first get their information, then a lot of information, especially for compliance needs. So by US law, the only accredited investors and the ones who pass accreditation check are able to invest in private investment offerings. So it is incumbent upon the issuer, in this case, the fund manager, to collect the information and to run the checks and also to get the documents signed, and then do follow up to eventually issue capital calls to get the money in. Of course, then it's a lot of going back and forth, and especially if you're using multiple tools to do that, like email, phone call, then it's very easy to get out of hand because all the kind of engagement information sitting somewhere. And then eventually it's your job to get everything together for operational purpose, for fundraising purpose, and also for compliance purpose. So that's usually kind of keeping the smaller managers away from pursuing the strategy of getting smaller checks from a large number of people.
In what ways is AI changing the private investment market?
As of today, given the conservative culture of high finance, it started off mostly from back office, middle office functions, like away from where investors can see. So for instance, where we started is by using AI to facilitate the document mapping process to create an e-signature document template. Traditionally, if you use let's say DocuSign, you need to manually decide how many fields of information you want to map to the templates and to do it manually. And as of today, we're able to use AI to actually read the legal documents and to make recommendations on how many fields are blank and that require certain information. And then going further to say, hey, this field looks like it needs a number or text or something, and further converting that into a digital questionnaire that to allow investors to simply use drop-down list or radio button to select certain things. So all the information can be pre-populated on the final subscription documents without typing anymore. So those are the places where we see immediately we like to use AI.
What is required to leverage AI for higher efficiency?
Really the infrastructure. So AI essentially is the mechanism to do information processing and the decision making. But in order to do that, one, you need data input. So you need infrastructure to collect data. And two, you need action engine. So once you make a decision, you need to be able to effect a certain kind of action. So those are the two pieces you must have in place in order to for AI to actually to do something useful for you. For instance, the data collection engine. If you're not kind of interacting with the endpoint users directly, then where does that information come from? And traditionally, it has been mostly manual upload, but that is not sustainable because it's a static. You need a way to continuously, once you have the data collection, then make a decision and do certain action, then repeatedly collect the updated information back and to allow the engine to continuously processing. So that is what's missing. Therefore, infrastructure is really what's missing here.
What are the barriers to mass distribution?
Lack of efficiency, lack of infrastructure. And also in some cases, is the incumbents' reluctance to engage more innovative technology.
What role will tokenization play in mass distribution?
It will be positive overall. The real value of that is still yet to be seen because in essence, and then for tokenization to be really useful, at least the initial promises, there should be liquidity in secondary market for the private investments represented by the tokens, and that is a bigger problem to solve. How do you introduce a mechanism who is participating in both sides to make the market liquid? I think without addressing that fundamental problem, and then the technology itself that enables tokenization is already there, and the regulation that enables tokenization is already there in place, but we don't have the effective solution to, I would say, to introduce the liquidity to the illiquid market yet. So that's we're waiting to see how it will shape out. So in this case, it's the sort of the reverse, and that the infrastructure is there, but the mechanism or the participation is not there yet.
What is the probable success of using tokens for collateral transfer?
I guess the fundamental question to that is what makes it superior to the current system. And the current system, if it's mostly bilateral, and then it's operating on, let's say, exclusive club network, and then opening up with blockchain technology can certainly make it more efficient and reaching to a much larger network. And therefore, then from the infrastructure standpoint, that it will be very beneficial. But in this case, I believe still the technology is ahead of, say, the people's behavior. So it will take some kind of a strategic alliance or some kind of partnership to normalize the legitimacy of such kind of network use.
What is the most promising solution to mass distribution?
The most promising one, as we can see, is really technology and infrastructure. So that's essentially it's going to bring down the transaction cost, both from the supply side and the demand side. From the supply side, that makes the supply, let's say, fund managers make their job easier and more cost effective to connect with the investors, to process their paperwork and perform reporting and let's say data distribution, performance reports and tax reports distribution. So that makes their cost lower. Therefore, they can in turn pass that as a return to their investors. And from the demand side, that the technology, especially AI, LLM, allows them to possibly become more efficient in performing due diligence and deal sourcing identification. That's one hand, deal identification. Then once they identify that, then among themselves, especially wealth managers, advisors, and then once you need more infrastructure to actually support non-standard alternative asset reporting and to their own investor clients. So that's where that's where the infrastructure can play a key role. Once the infrastructure is in place, and then I project that the alternative assets that you just become just like a public traded equity, become one of the stable in one's portfolio.
What makes a good WealthBlock customer?
Mostly comes down to your investor acquisition strategy. If you're going for, let's say, a large number of investors, either they're institutions or individuals, doesn't really matter. And then once you go over, let's say 50, and then you will find yourself in the position to decide and just, I mean, how much of a paperwork you want to handle manually? Can you handle manually? And then that said, then you have the traditional crowdfunding firms that's facing that challenge. They got thousands, but each one of the rate, let's say the check size, investment size is too small. Therefore, that's a kind of conundrum that they're facing as we speak right now, because the technology has a cost, compliance has cost. So if you're raising too small from each investor, then the operational cost is still there. Then how do you justify that with your unit economics? Therefore, from what I've seen so far is that when you are in growth mode as a private fund manager going above, let's say $100 million AUM, you're raising at least 50 to 100 million from, let's say, 30 plus investors. And the larger number that is, the more you need technology and the more value you're going to realize as a result of that.